think it depends on how you look at this rotation. One has to understand the context. I mean, as you said earlier, we've had a secular period of significant outperformance of growth stocks, really since the financial crisis for 12 years. And that secular trend was stronger and longer than we've really ever seen before. There were good reasons for it, of course. Very low growth after the financial crisis, extraordinarily low rates, which boost the value of long duration assets, and of also the success of the technology industry. But we have seen a pickup in cyclical parts of the market, more so than value. Value has only more recently started to recover as you begin to get steeper yield curves, which has helped the banks, and rising commodity prices. And as you heard from my colleague, Jeff Curry earlier, we think that has further to go. So I think given where we are in the business cycle, this has yet more legs to it in terms of the bull market and in terms of the rotation of leadership.
Yeah, but dare I say it, Peter, you're of a vintage like some of us around this desk, not all of us, who've been around a long, long time. And as such, you remember peak valuations back in 1999, 2000. The comparisons are beginning to look strangely familiar.
Absolutely. If you look at valuations of equities on multiples, PEs, for example, you're beginning to see something approaching the levels that we saw at the peak in 1999. They're not at those levels, but getting closer to them. If you look at the S&P, the PE is in around the 96th or 97th percentile of its long-term history. And even in Europe, which is, as a market lag behind, you're seeing, the highest sort of multiples since that bubble period. That being said, of course, there's a massive difference in the comparison of valuations between equities and bonds. You have to bear in mind that even before the financial crisis, 12 years ago, 10-year Bund yields and US 10-year Treasury yields were over 3%. Now you have negative yields in Germany and barely 1% in the US. So if we look at things like the equity risk premium, which in the case of Europe, for example, we estimate to be about 6.5%. That's very high by historic standards. If you go back to the last time PEs were at this level, in the late 1990s, we estimate the equity risk premium was only around 2%. So that's really the supporting case for equities. It's a relative story. Absolute valuations, I agree, are high, and they do leave less room for further valuation expansion to be a driver of returns in this bull market.
Peter, given what you said, what does that mean in terms of earnings season? Because rival house Morgan Stanley has been arguing that given the adjustment in rates, that it does put some focus on companies that are performing, that have the earnings that they can deliver at this point in the cycle. What do you think the relevance is then of the report cards we're going to get in coming weeks?
I think we're going to get a good season. If you look at earnings revisions, historically, as many of us know, year after year, in general, earnings are revised down. The exceptions nearly always are when you're coming out of recessions, when you get a trend of upward revisions to earnings. We've begun to see that this time. We think there's more to it, particularly given our own view that the inflection point in global growth is going to be stronger than the consensus currently expects. And I would say, look, we've had a massive fall in profits. We've had a hugely deep recession for obvious reasons. But we're looking at global profit growth of around 35% this year and continuing in double digits into 2022. It's going to take a long time to get back to peak earnings in some cases. So in Europe, for example, even with 40% profit growth in our view this year, we don't get back to the previous highs until sometime late in 2022. But it's this inflection point which I think is important. I would expect the near-term earnings season to be really quite good as operational leverage kicks in, as companies tend to benefit from this pickup in revenue growth.
Peter, over the last number of years, we've been talking about a barbell approach for investors as they chase risk, but also protect some of the portfolio. What do we have from here? Because as you have this call for 6.5% real GDP growth globally in 2021, there is still a risk around how the vaccine plays out and whether that's positive for taming the virus at this point. Do you put some hedges in place just in case of a negative turn from here?
Yeah, I think that's a very good point. And it's also important to emphasize that in recent years, it's been relatively easy to hedge portfolios, particularly on a multi-asset basis, because equities and bonds have done well together, but they've been good hedges against each other. 60-40 type portfolios have done extraordinarily well. Also an environment of structurally low volatility, and that's becoming harder, I think, to envisage as we move forward. And as we move into this more growth-orientated phase, it's not unusual for volatility to pick up as well. And that means that in the short term, volatility can work in both directions, and near-term setbacks would not be, I think, unlikely. So it is going to be harder to, I think, hedge portfolios. And over the medium to longer run, because valuations of equities, for example, are much higher than they were at the trough in 2009, the last big trough after the financial crisis, and interest rates are much lower, the aggregate returns over the medium to longer term probably will be lower in markets. But we do think there's going to be great alpha opportunities, the potential to pick the differences between companies, much more than beta. And that's really where I think the hedging element will come in, really looking at the differences between relative winners and losers much more.